Good afternoon. I hope you can hear me clearly. Can we get rid of that echo?
Sorry, they got to turn the noise down.
Sorry, I'm getting an echo here, which we're trying to get rid of.
They have to fix that.
Could you just explain what they've got to do to get rid of the echo?
You have to lower your noise in the room in order to fix the echo.
Okay. Can you hear me now, or has that switched it off completely? Can somebody wave if you can hear me? Okay, good. Right, that's great. Thank you. You can hear me, and there's no longer an echo. First of all, can I say I'm terribly sorry that I couldn't be with you in person this afternoon. I'm actually speaking here from Washington, D.C., where there is a conference on macroeconomics and macroprudential, which is covering some of the issues, and I had to speak here at lunchtime, so I've got to come in by video conference. And it's particularly sad that I haven't been with you, because I've greatly enjoyed and admired reading the works of both Michael Kumhoff, along with Jeremy Benez, and indeed Larry Kotlikov's. And I think they've done a great service in making sure that we think about radical ideas of reform, radical ideas which go beyond the incremental improvements in the stability of the system with which, as a public policy official, I've necessarily been involved over the last 5 years. Now, that doesn't necessarily mean that I agree fully either with Larry or Michael with their precise propositions, but I think that there are some underlying principles which they are setting out, and which, as Michael's paper in particular describes, were set out very clearly by mid-20th century economists like Irving Fisher, like Henry Simons, like early Milton Friedman, and that those principles are very important for us to understand and to guide as best possible a policy action. I'm now out of the official public policy role, and that hopefully enables me to be a bit more radical. I've tried to be relatively radical and straightforward even while I've been in that role. But when you get to the end, as I have, of 4.5 years as a regulator, one of the things that you do is reflect on what we did, reflect on what fundamentally went wrong, and go back to basics to think about do we need to have a more fundamental reform to make a more stable system. What I'd like to do is make 5 points. One, I'd like to set out what I think are some important issues which were ignored before the crisis, the latest financial crisis, and some principles which I think are important. And I'd like to focus on the problems that debt and banks can create in the upswing. I'm then going to, on the second thing, say some words about why that creates particular problems in the downswing as well, and the links between some aspects of monetary policy and macroprudential policy. Third, I'm going to talk about the way that suggests a possible need for radicalism along 2 dimensions, in macroeconomic policy and in macroprudential. Fourth, I'm going to step back and say that the fundamental issue is, do we believe that maturity transformation is a good thing or not? And fifth, I'm going to suggest a possible way forward, which is not quite as radical as to what Michael and Larry are suggesting, but still I think you'll find a way outside the bounds of what we've debated within the policy space over the last 4 years. So let me begin by, I think there are some very important insights into the nature of financial stability and macroeconomics which were almost entirely ignored before the crisis. Olivier Blanchard, the chief economist of the IMF, said last year that one of the faults that economics had before the crisis is that we thought we could ignore the details of the financial system. And that is largely true. The new Keynesian macroeconomic models largely just didn't have a financial system in it. which is a fairly extraordinary fact, but true. What is also true is that before the crisis, I think we fell into, and it had been over several decades, a tendency to believe that financial markets are just markets like any other, and that the propositions which in favour of free markets, which are pretty good in other sections of the economy, apply also in finance. Basically, if we want a good supply of restaurants, of a variety of ambiances and price points with good service, there isn't really a better system than having a free market in which entrepreneurs create a concept, some win, some lose, some go bankrupt, some flourish. The free market works. I think one of the most fundamental things for us to understand is that finance is different. That finance is different because it is linking the present to the future under conditions of inherent irreducible uncertainty, and because it deals with money, which is a very complex and difficult and distinctive element of our economies. And the fact that we thought that the market for money or the market for financial instruments is just like the market for finance was a major mistake. Finance is different. It can create instabilities. It can create rent extraction opportunities. But within finance, debt contracts are even more different. And I think there are 5 reasons why debt contracts, as people like Henry Simons and Irving Fisher described, create risk, and why the bigger the amount of debt contracts within our economy, the higher the level of debt to GDP, the more fragile is likely to be our macroeconomy. First, debt contracts are different because of what Andrew Schleifer has called local thinking, which is a form of sort of partial blindness, a failure to see the world as it really is. If you hold an equity investment, it is obvious to you that you are holding a risky investment because it goes up and down in price day by day. The movement in the price day by day is continually sending you a reinforcing signal that reminds you that you hold something which is risky. When you hold a debt instrument, in the good times, all that you see is the bit of the frequency distribution of possible results, which is the favourable 100% payout result. And what happens in the good times is that there's a systematic tendency for people to believe that the observed bit of the distribution of possible results is the whole of the distribution. They end up believing that some instruments which are inherently risky, because there is real risk out there in the economy, are in fact riskless. And as a result, the free market left to itself has a systematic tendency to create more debt contracts than is optimal, and as Andrei Schleifer puts it, a tendency to create many debt contracts which, and I quote, owe their very existence to neglected risk. And we saw enormous numbers of such debt contracts before the financial crisis. Debt contracts which people assumed were AAA, were safe, but which owed their very existence to neglected risk, which but for that partial blindness would never have seen the light of day. That's the first difference. The second difference is the impact of bankruptcy and default processes. Ben Bernanke, in his essays on the Great Depression, has a phrase which says, in a complete markets world, bankruptcy would never be observed. In the world described by smooth neoclassical economics functions, what would happen with a debt contract is, as the operating risk of the firm grew, there would be a completely smooth process of renegotiation of the debt contract to have elements of equity. It would be an entirely smooth process because most of neoclassical economics works on the basis of nice, smooth functions. But actually, in the real world, we see processes of bankruptcy and default. What happens when you foreclose on a debt contract is that you go through processes which in themselves destroy value, which tend to produce asset price falls, and which tend to produce knock-on effects of the sort that propagated the Great Depression. Thirdly, debt contracts have to be rolled over. You can imagine a market economy operating for many years, let's say 5 years, with not a single new equity issue. It wouldn't be a perfect market economy. It would slowly get less effective in terms of the allocation of capital. But you can imagine it because at least the equity which had already been invested does not have to be repaid. That is a permanent investment. But debt typically has contractual terms of 1 or 2 or 3 years or so, particularly in the corporate space. So it's being continually repaid, and therefore to maintain the same level of capital support to, for instance, a business, it has to be continually rolled over. And that means that the continued health of the new credit provision process, if you have already allowed large amounts of debt contracts to exist, you need a continual process of rolling those over. Otherwise, you will have a contraction of the credit and a contraction of the real economy. But fourth, and this is crucial to Michael Kumhoff's paper on the Chicago Plan Revisited and to the work of Irving Fisher and Henry Simons and co., it's not just that debt is different. Banks are even more different than non-bank debt contracts. I think maybe I focus more than maybe Michael or some others on the dangers that you would have even if debt contracts were provided in a non-bank fashion. But where I certainly agree is that fractional reserve banks create a whole new level of danger. Because the fundamental fact is that when people say banks take savings and intermediate it to loans, that's not true. One of the most fundamental insights, and it's very clearly set out in the front of Michael's paper, is that banks simultaneously create new credit and new money de novo, ex nihilo. And that is one of the most fundamental important things for people to be taught, which economics undergraduates should be taught, about the nature of how a monetary economy with banks works. The fifth and final thing is that lending against assets is particularly problematic. That when you have the ability of banks to create new credit and new money, and where that credit is extended against an asset such as a house or commercial real estate, which can increase in value, you have an extraordinarily strong tendency for what Hyman Minsky described, which is credit and asset price cycles. The very extension of credit helps drive up the asset price. The higher asset price makes the borrower think, oh, well, that was a good idea, I'll do that again, I'll borrow some more credit. The fact that the price goes up produces a period of low loan losses. That swells the capital position of the banks, who can then make more loans with more capital, and it also sends a reinforcing cycle to the lending officer, which says, well, I lent some money to commercial real estate and I haven't made much losses on it, so I'll do some more. You have these incredibly strong credit and asset price Minsky cycles, which have an upward spiral and then a downward spiral. That, of course, can occur within banks, but it can also, I think it's crucial to understand, and I think this is a crucial point in the evaluation of these radical options, it can also occur in shadow banks. Indeed, I have a fear that what happened before the crisis in the development of the shadow banking system is that we effectively created a sort of turbocharged and hardwired version of a Minsky cycle. Because what we did in the shadow banking space is that when you put together a money market fund providing a money equivalent instant access account, which takes that and then, say, lends at 30 days to an asset-backed commercial paper issuer, or lends through the repo market, or enters a complicated set of systems of securities lending and secured financing, what happens is that at each step, the totality of that chain is a bank but made up of many chains. But in order to try and make themselves safe, at various steps of that chain, people take security, they mark to market the loans effectively that they've made on a daily basis, and they call collateralized collateral against change in the mark-to-market value. And that, I think, has the aspects of the Minsky asset and credit cycle, but turbocharged and hardwired, made mathematically absolutely inevitable. So, debt contracts create risks which are not created by equity contracts. Banks create even more risk because they have this limitless ability to create new credit and new money. shadow banks can create money equivalents and can turbocharge the Minsky cycle. And the net effect of this is that banks, and I would now say shadow banks, have an inherent tendency to create excessive amounts of credit in the upswings and then to destroy it in the downswings. As Henry Simons put it in February 1936, in the very nature of the system, banks will flood the economy with money substitute during booms and precipitate futile effects at general liquidation afterwards. And it's very interesting to think that that's said by Henry Simons, who most people think of, and indeed was, a founding father of the Chicago free market laissez-faire school of economics. So here's somebody who believes passionately in free markets for restaurants or hotels or automobile manufacturers or soap manufacturers or whatever. But he thinks that finance is different. He thinks that we've got here something which is inherently unstable, which will create excessive amounts of money and money substitute during booms and precipitate future effects of liquidation thereafterwards. And therefore, he said, private initiative has been allowed too much freedom in determining the character of our financial structure and in directing changes in the quantity of money and money substitutes. And I think there should be a real pause for people to think about that a set of thoughtful people who in all other aspects of the economy were passionate free marketeers, sitting amid the wreckage which had been produced by the banking crisis of 1929 to 33, end up in a radical position where they believe that finance and debt and banks are so different that we should effectively abolish fractional reserve banks. These insights into the special nature of banks, of debt, of shadow banks, I think fundamentally challenge pre-crisis economic orthodoxy, which tended to assume that increasing financial intensity was limitlessly beneficial, and it assumed that on the basis of market completion theory. So within neoclassical economics, there is a fundamental proposition that the more contracts you have, the more markets you have, the more that we complete markets, and therefore the more that we head towards a sort of nirvana of a free market equilibrium as described by Kenneth Arrow and Gerard de Breu. But in fact, I think we know that the theory of finance, debts and banks tells us that there's no certain mechanism by which the amount of money and credit created is an optimal. Indeed, we have a system which is almost certain likely to take it to excess. And increasingly, I think we have empirical evidence supporting the proposition that there are levels of debt to GDP generated by, for instance, free banking systems, above which that level of debt to GDP is harmful to the stability of growth and to the long-term level of growth. I'm thinking here about the empirical analysis done by people like Alan Taylor and Maurice Schullerich, or the BIS document from July last year, in which Steve Cicchetti and Anis Karoubi argue that when you plot debt to GDP, private debt to GDP against long-term growth rates, you end up with a sort of inverse U function, where financial deepening, some level of debt to GDP, is positive for the economy up to a certain level, but there is a level which the developed economies are beyond, which is negative for growth. These insights are important. They were ignored pre-crisis. Credit to GDP grew massively over the 50 years pre-crisis, both in the real economy and within the financial system in itself. And the crisis created huge harm. And I think it's very important for us to understand the nature of the huge harm that the crisis created. Some people try to measure that through the costs of taxpayer bank bailouts and say the crucial thing is to end too big to fail. But actually, the cost of taxpayer bank bailouts is either in accounting terms nil. In the US, the Federal Reserve, except in the case of Fannie Mae and Freddie Mac, but in relation to all the other interventions, is highly likely to end up with a net profit at the end of the day. And even in the UK, where we probably face a net loss on our equity investments in RBS and Lloyd's HBOS, the total cost there is just a couple % of GDP. That is the short change. That's the small change. It's the most unimportant element of the total cost of the crisis. The total cost of the crisis is the macroeconomic recession into which we have been tipped. And that's the way that extra credit created in the upswing by the banking and shadow banking systems then produces a downswing thereafter. That's what we ought to focus on. So, I think that was my first point. Banks are different, credit is different. Left to itself, the system will produce too many debt contracts, too high leverage. My second point is that when you've done that, when you allow that to occur, you then face a huge problem in the downswing. And the downswing is characterized by what Irving Fisher describes as the debt and deflation cycle in a great and short and very accessible article, and is characterized by what Richard Koo, in his analysis of Japan over the last 20 years, describes as a balance sheet recession. Essentially what happens in this balance sheet recession is that once the crisis occurs, both companies and households, it's different mix in different economies according to where the leverage developed, but it could be either companies or households, suddenly become convinced that they've got too much debt. And they therefore become determined to pay back that debt, to deleverage. And in that environment, they become almost entirely inelastic to a stimulus provided by low interest rates. You reduce the interest rate to the zero lower bound, but people don't borrow more money because they're basically trying to pay back the debt they have already got. And this is the liquidity trap in which reducing the policy rate, interest rate, the Fed funds rate to the zero lower bound just doesn't stimulate the economy. We end up in a trap. Now, of course, in that environment, you can then say, okay, well, we'll go beyond simply reducing the interest rate to the zero lower bound, and we'll do all sorts of unconventional monetary maneuvers, such as quantitative easing, credit easing, direct credit subsidy, central bank liquidity support, forward guidance on interest rates. And what all of those, which are being deployed by central banks across the world, are trying to do is influence a wider set of interest rates than the policy rate alone. They're trying to influence long-term interest rates as well as short, forward expectations of future interest rates as well as current rates, the rates actually paid by borrowers in the real economy, as well as the Fed funds rate which exists in wholesale money markets. But the problem with those sort of policies, which work through those mechanisms or through asset price effects, i.e. the QE pushes up the price of bonds or equities, investors feel richer so they spend more money, or they go out searching for yield. The problem with that is twofold. First, if you're really, because of a debt overhang, in a balance sheet recession, then the fact that you are able to influence a wider set of interest rates still may not make much difference. Borrowers may still be inelastic to changes in the long-term interest rate as well as the short-term interest rate. They may be inelastic in response to the rate that they specifically pay as much as in relation to the policy rate. So that's one danger, that it simply isn't very effective. The other danger is that we are attempting, when we use these unconventional policy levers, to re-stimulate the economy through the mechanism of the famous hangover cure, where you take another shot of alcohol, the hair of the dog that bit you, in the British phrase. And there is a real irony if, faced with a crisis which has been clearly produced by too much debt, we end up with a set of policies, the purpose of which is to stimulate people into taking on more debt. And there are very major dangers, as Jeremy Stein of the Federal Reserve Board set out in a lecture in February, that these processes of unconventional monetary stimulus will, long before they have a really powerful effect on the real economy of households and companies, will stimulate all sorts of carry trade and put option writing and leveraged activity in the financial system, which will recreate forms of a financial stability risk. So that's the situation. That's the problem we've got. Too much debt in the upswing and a balance sheet recession, deleveraging in the downswing. My third point then is that observing those two problems, that suggests the need to consider greater radicalism of public policy along two dimensions. In macroeconomic policy, it suggests that there might be circumstances of deflation and deleveraging so deep that you have to consider the option which Ben Bernanke's proposed for Japan in 2003, which is helicopter money, printing money, financing an increased fiscal deficit. Some people, the moment they hear that, say, oh my God, that's hyperinflationary. That's a terrifying thing to do. But I give you another irony from the history of economic thought, along with my previous one, that Henry Simons, this great laissez-faire free market economist, proposes the complete abolition of banks. The other irony is that Milton Friedman, a man who most people think was absolutely determined to fight against inflation, proposed in 1948 that not only should we sometimes pay for public deficits with new created money, but that we should always do that, that should be the standard form of fiscal deficits in order to produce a steady increase in the money stock, compatible with a slowly, steadily growing low inflation economy. So in macro policy, the observation of this extreme liquidity trap can take you down the radical route of helicopter money, the creation of irredeemable fiat money to create demand. And the observation of the harm which leverage has done takes us to the idea of how do we have a dramatically less leveraged economy for the future? How do we manage to write down existing high levels of debt and or to achieve fundamental changes to the financial system, for instance through the abolition of fractional reserve banks, creating an environment in which the pace of nominal demand growth is no longer dependent on the growth of private leverage. Now, these two elements are closely linked. The idea of money finance of deficits and of radical change to create 100% reserve banks. These are logically linked, and they are logically linked in Michael Koumhoff and Jaromir Benes's paper, and they were logically linked in the writings of Friedman in 1948 and Irving Fisher and Henry Simons. So what do we think about these? Let me give some thoughts. I mean, essentially what Jaromir and Michael have done is propose a revisiting of the Chicago Plan. And this would involve banks being 100% reserve backed, a variety of different possible ways to provide loans in the future, either through treasury loans or essentially equity backed, which would make them somewhat similar to Larry Kotlikov's idea of limited purpose banking but equity backed loan funds, and with credit creation essentially focused on investment in real activities rather than in, as much of it is today, on intertemporal consumption smoothing as between old and young or patient and impatient. And just so you just understand how little of current bank credit is focused, at least in some countries, on investment in real activities, just suggest the following figures. In the UK, the sterling lending of the UK banking system is about 1.8 trillion pounds sterling. Of that, about 1.3 trillion is either house mortgage loans or short-term consumer credit loans. And in the UK, unlike, for instance, in Ireland or Spain or the US, very little of the house mortgage loans have anything to do with the construction of new houses, because we don't construct many new houses in the UK. It's almost entirely to do with the financing of an exchange of pre-existing houses between old and young people, or those who have houses or not. So 1.3 out of the 1.8 has very, very little to do with the real investment process. Of the remaining 500 billion, 280 billion is lending to commercial real estate companies. Now, some of that is real investment in, attractive new commercial real estate investments, but a hell of a lot of that is also simply financing asset plays on existing commercial real estate assets. So you're down to 220 million out of 1.8 trillion, which is actually due lending to the non-real estate companies. And indeed, if you look at the manufacturing sector in the UK, they are net depositors into the banking system, not net borrowers from it. So I think it's very important for us to understand how little of the present banking system actually is the sort of activity that you get iconically described when people are arguing, keep away from the regulation, which is investment going into new companies, etc. It's a very small part of what most banking systems do. So that's the proposition into different ways, Michael and Larry's things. I think there are a set of issues which might make me not fully convinced to say, yes, I'm going to sign up to the Benez-Kumhof Chicago plan. I interchanged quite extensively with Michael by email a couple of months ago. I think the new version of the paper addresses some of the issues, but there are some issues that I'm not absolutely clear that make this in total doable or necessarily desirable. First of all, I think that any system which involves a big write-off of existing debts, however hard you try, is going to somewhere in the system create winners and losers. I think it's almost impossible to do large debt write-offs without some distributional consequences, and I think that's just very difficult politically, as well as creating some simply uncertain consequences which will result from distributional effects on wealth. Secondly, I think there's an open issue about how we should think about lending for intertemporal consumption smoothing. I think there's far too much of it, but I think there could still be an argument that some of it is valuable up to a point. I mean, the basic process of saying we enable younger people to borrow money to buy houses off older people, rather than all houses flowing through an inheritance process or being bought by the accumulation first of enough cash to buy them, I'm not convinced that I think that may have a social welfare optimality. I think one of the most important bits of economic theory that we really haven't thought through is what is the social optimality there, how much is socially optimal, but I think that's an unexplored bit of economic theory. And even some element of lending from patient to impatient people, may be socially welfare optimal, even though it has absolutely nothing to do with creating higher growth. So I do have some concerns about the distributional issues, about how should we think about intertemporal consumption smoothing, and I do have some concerns that any attempt to create an entirely 100% reserve banking system would be likely to create more shadow banking systems, near money substitutes. I'm more doubtful than Michael is about the ability of us to prevent the creation of near money substitutes. And in relation to Larry's proposals, I'm not totally convinced that it would get rid of pro-cyclicality, given that I think that mark-to-market systems in the shadow banking system were themselves a cause of pro-cyclicality. I can imagine that if we have loan funds, mutual loan funds, in which you hold a mark-to-market investment, and if we can really mark-to-market those on a day-by-day basis, or even week-by-week, I think we may see some pretty strong pro-cyclical behavior in response, in self-reinforcing cycles, in response to the mark-to-market of the value of such funds. So I do have some questions about the precise forms of radicalism. And underlying those questions, there is a fundamental issue, which is, what do we think about maturity transforming banks? Is there a useful role for maturity transformation to enable the creation of debt contracts beyond those which would otherwise exist? Now, I think Larry and Michael and others in the really radical camp have convinced themselves that there's no value in that at all, and we should simply abolish it. I don't think I'm in that space, but I'm sort of well aware, I'm convinced that left to itself the system does more maturity transformation and more debt contract and money creation than is optimal, but I'm not quite in the space of believing that we should abolish it entirely. I think it's possible that there is some role for leveraged maturity transforming banks to create a wider set of debt contracts than might otherwise exist. Walter Bagehot in Lombard Street certainly argued that that had played some role in the superior early development of the UK economy versus, for instance, the French economy, and I don't think that's an entirely fanciful a concept, though it could certainly be challenged. But I certainly believe that the amount of debt contracts created by purely free markets is likely to be deeply suboptimal. There'll be too much. I believe that strong reasons to believe that left to itself, the amount of debt contracts will always be suboptimally large. So, I'm therefore attracted to what Jaromir and Michael in their document set out in section I, which is compromise solutions. And I hope I'm not simply being wimpish and going for the compromise solution. And I note that in that section you very carefully, very politely point out that those who go for compromise solutions are sort of intellectual wimps. They're not really going for the absolutely, pure version. But let's talk about what a compromise solution might be. One way forward has been suggested by Anat Admati and Martin Hellweg in their new book on the bankers. What's the title called? The Bankers' New Clothes. The fact that bankers are running naked, and we've not admitted that so far. They basically argue, and I entirely agree with them, that as regulators today, as policymakers today, we are the inheritors of a 100-year policy mistake in which we have allowed banks to operate with ludicrously high levels of leverage, which are completely unnecessary for the effective operation of a market economy. And they argue that in a perfect world, we wouldn't be playing around with Basel III, where those of us like me who spent many, many hours in windowless rooms throughout the world negotiating it, were very proud if we managed to get the leverage, the capital ratios up from 5 to 6 to 7. They say, forget all that. The optimal level is something like 25 to 30%. And I believe that. I believe that if one were fortunate enough to be the benevolent dictator of a greenfield economy and able to simply ignore transition problems or political disagreements between different authorities throughout the world, I'd go for something like a 25 to 30% equity ratio. But I think it's then important to realize two potential problems with that Admati and Hellweg approach. First, setting capital ratios, however high, does not actually necessarily constrain the total level of debt contracts in society, because you constrain the ratio of total bank loans to equity, but you don't constrain the amount of equity that people choose to put into the banking system. And if you had equity ratios of 25 to 30%, investments in bank equity would be very low risk. These would be your classic utilities in which widows and orphans, the famous iconic figures, ought to invest for dividend return. And I think you might well find that there's quite a large supply of people willing to invest in bank equity as a not far off deposit equivalent. It wouldn't be money, it wouldn't be usable as money, but in terms of a store of value, it would be seen as a pretty safe store. So I think you could have the Admati-Hellweg very high capital ratios, but still end up with the system generating debt to GDP ratios which were suboptimally high. And the fundamental problem here is that when you constrain banks through the capital ratio, you're constraining a ratio, but you do not directly constrain what the numerator is, how much capital there is. And that is different from when you do it on the reserve asset side of the ratio, where if you have quantitative reserve asset requirements, you not only can impose a ratio, but you can impose, you ultimately determine how many central bank reserves at the central bank there are. So I suspect that if we really have to wanted to go forward with the Admarty Hellwig compromise radicalism, we might have to combine very high equity ratios with the restoration of quantitative reserve requirements and pretty high reserve requirements, which again is, I'm afraid, yes, a compromise solution that I see that Jaromir and Michael criticize, as indeed did Irving Fisher. It's sort of, well, we proposed 100% reserve requirements and you're coming back with X, which is quite large but not 100%. But that's where I might be. Second concern I have with Admarty and Hellwig is, how are we going to deal with the transition? The fact is, it would be much better if we had not created all these debt contracts in the economy, but we have. And given that we have, if we simply come along and say, you've got to hit a much higher capital ratio, there is a danger that left to themselves, the banking system will choose to meet those higher capital ratios through a speedy process of deleveraging. And while that deleveraging at one level is required to end up in a more stable overall economy, in the short term, given the starting point that we have, it could be depressive to the economy. Therefore, if you go with the Hellwig-Admarty mechanism, I think what you've got to do is demand a higher capital ratio and demand that it is met through an increase in the numerator, not an increase in the denominator. But to do that, you've really got to backstop that requirement for a higher capital ratio with a statement which says, and if you don't manage to get that higher equity in the private equity markets, we, the public authorities, are going to subscribe that new equity. And my third concern, even with the Admarty-Hellwig compromise, is shadow banking and arbitrage and avoidance problems. I am very struck, one of the main things that I've looked at over the last 2 years is the development of the pre-crisis shadow banking system, and I've been very struck by the way that it is able to create alternative ways of bank credit equivalents, near money equivalents. I think we're seeing across the world that there are a lot of arbitrage opportunities. Look at China, major developments of a shadow banking system there. And I think essentially the system can produce near money equivalents which are not dependent on the underpin of deposit insurance and lender of last resort, but which are created by the use of collateralization and haircut techniques, which as I said earlier, can be even more unstable and even more pro-cyclical than banking per se. So I'm interested in that intermediate solution of the Admarty-Hellwig approach of very high capital ratios combined with the restoration of quantitative reserve requirements, which is heading a bit towards 100% reserve banking, but not the whole way. But I am aware of problems. Let me then end with one possibility of how we might head towards that, one very radical proposal, which ties together what I said earlier about radicalism in the monetary space and helicopter money drops, money finance creation, and heading towards a more stable banking system. Suppose we made a policy commitment which required banks to increase their equity ratios to the sort of 25 or 30% that Martin Hellwig and Anat Admarty had proposed. We'd combine that probably with a process which said, and if you ever fall below 15%, we'll take you into some sort of central bank conservatorship, tidy you up again, write off the existing equity, and refloat you. Therefore, with very strong incentives for sound bank management, which would never let it get down to those 15% levels. We require that of the banking system. We make it clear that if private equity is not available to meet that higher capital requirement, we will have public funds injections into the banking system. But that fiscal injection would be paid for, if needed, entirely with new central bank reserves. You can think of this as a Bernanke helicopter money drop, totally dropped into bank equity rather than into Milton Friedman's famous dollar bills lying around the grounds. The political economy benefit of this is that if the helicopter money drop is limited to this exercise only, this specific exercise of heading us towards a less leveraged banking system, it does not raise the political economy dangers that make people very terrified of the more generalized use of money-financed government deficits, which is the danger that once politicians realize that it's possible to finance deficits with money, they'll want to do it all the time and to excess rather than in an appropriate amount and at the appropriate time. These measures of creating a more liquid and more capitalized banking system would, however, have to be combined with measures which directly control both borrowers and lenders. It would have to be combined with things like LTV and LTI limits in key areas such as residential housing. It would have to be combined with much more aggressive than currently planned use of counter-cyclical capital requirements, particularly in things like commercial real estate. And it would involve the restoration of the policies tool of quantitative unremunerated reserve requirements to ensure that the new reserves created cannot limitlessly create new money constrained only by that imperfect equity ratio constraint. And this policy would have to be contained with very tight control of shadow banking, capital and liquidity requirements on money market funds, minimum haircuts in repo and secured lending and securities financing contracts, and the ability of the regulators to impose leverage and liquidity constraints on any institutions which over time became bank-like in nature. So what I've ended up by doing is agreeing with the analysis of Michael and Larry, who are there, that there's something very fundamental about too much leverage and something very fundamental about fractional reserve banks. But suggesting, yes, a compromise solution which does not abolish fractional reserve banks, nor abolish, as Henry Simons wanted, debt contracts, but which, in a sort of intermediate level of radicalism, though I have to say still radical enough that it'll probably give some of my erstwhile colleagues in the official sector a complete shock when they read it, a process which would end up take us towards a dramatically less leveraged banking system without that costing an increase in fiscal deficit because of the use of money finance credit. So that is taking some of the insights from Michael and Larry and others' analysis, some of their radicalism, but suggesting a way forward which would still be incredibly difficult to get political support for, but which resides in an intermediate radicalism space. So thank you very much for listening, and I'd be happy, if we can, to take questions from the floor and respond to it over the next 15 minutes. Thank you.
Thank you very, very much, Lord Turner.
And I think you now have to switch on the audio, because I can see you clapping silently at the moment, but I can't hear anything.
Can you hear me? Can you hear?
I can hear you now, yes.
Thank you very much. Really appreciate your insightful analysis. I have a question. By the way, you know we're streamed live. Half of our audience is around the world live, and half of it is right here in this room, approximately. Okay. Here's a question from Positive Money from the UK. I know you're aware of their work. Here's their question. You agree that we should not prohibit fractional reserve banking because maturity transformation is useful. But if there was a way of allowing maturity transformation without the creation of private money, then would it be worth preventing private money creation via a fractional reserve banking system?
That's interesting. I mean, obviously you could have the state play the monopoly role as the maturity transformer. I guess I'm a little bit wary of that, and I hope I'm not just being institutionally conservative and accepting the world as it is, because I do have, significant concerns about state direction of investment funds. I think there's a whole set of environments that believe that's not very successful. So I think I'm still in the camp of believing that very tightly controlled by the sort of mechanisms that I have, we can take the benefits, and I think there still are some benefits of a free system of competitive fractional reserve banks. I mean, essentially I'm saying there can be a role for fractional reserve banks, but the fraction never needed to be anything like as small as that which we allowed to develop in the pre-crisis period. So I think we should certainly be open to a range of radical ideas, but I think, convinced that with a radical enough set of regulations, we can constrain the fractional reserve banking system to prevent it being the dangerous driver of excess credit and money creation, which it has been in the past. Another question?
Hi, Adair. It's Larry Kotlikoff. Great presentation. Very much enjoyed your remarks. Agreed with a few of them. So one thing on the maturity transformation, you know, there's this paper by Charles Jacklin that shows that you can achieve the same equilibrium as you would have, the same good equilibrium as you have in the Diamond-Dybvig model with just people buying short and long dated securities without having the bad equilibrium, the bank run equilibrium. So that's one question for you, and it connects to the question that was just asked, whether there's an alternative mechanism for maturity transformation. You know, after all, it's trying to ensure people that it suddenly become impatient. I think that's all fourth order, to tell you the truth, as an issue, but even so, security markets can seem to deal with that. But my other more important question is, in your entire talk, there was no discussion of disclosure, of transparency. If you have financial institutions, no matter how much leverage how much capital they have, if nobody can see what they're actually investing in, then the market can lose faith in the value of those of the capital. And in the case of Lehman, 3 days before it failed, it put out a glossy report that was approved by the SEC. It was in effect a stress test for Lehman Brothers that said that its capital ratio was 11%, which is higher than most U.S. banks now have under our stress test. So I'm not sure that capital ratios are, I don't think you can be kind of a little bit pregnant here. You have to, I think we need to have full disclosure by a government agency of the securities that are being marketed to the public. And I think that as soon as you introduce any leverage potential, you have this entire regulatory structure, huge regulatory structure that you need to have in place. And furthermore, the issue of capital requirements, you know, think about AIG engaging in the sale of CDSs. Now, in effect, that was leverage because they were committing to pay back in certain states of nature huge amounts of money, and they didn't have it. It wasn't in all states of nature, but in certain states of nature, when the company they were insuring was defaulting on its debt. So, what is leverage is a kind of an open question, and whether the capital requirements would cover everything that's leveraged, and whether the companies would then buy securities that are themselves more leveraged. All these problems go away with limited purpose banking, but are there with your compromise.
Okay, let me pick up a couple of points. I think I'm less convinced than you are, Larry, of the mileage that we can make by transparency. And let me try and illustrate this point. That people sometimes say, I remember in the autumn of 2008, when I was right in the middle of the financial crisis, and people said, look, what we've got to do is force the banks to tell us how bad the losses are by telling us about the quality of their assets. The trouble is that there is no answer to that question, because the value of the assets is deeply endogenous to what is about to happen to the economic cycle. If there is confidence in the system and they have enough money to make some more loans, the value of those assets is higher. If the system goes into a downward spiral, the assets are worth less. There is no such thing as the value of the assets in some defined sense. It is, I think, deeply endogenous to the state of the economy, which in itself is a continually evolving process. So I'm more wary, I think, than you, Larry, about disclosure will do it all. And indeed, I'm slightly worried that incredibly wide disclosure, combined with the tendency of financial markets to be subject to herd effects and rumors, can produce continual mark-to-market cycles, which in a sense are self-fulfilling. So my response is, what you've got to do is just have enough capital that in the face equity capital, it's going to be pure equity capital, that you have a high degree of confidence that if there is, the assets turn out to be worth less than you thought they were, the worst that can happen is the equity holders lose. And it's up to them to have a dialogue with the managers of the bank about what they need to do. So as long as you can get yourself to a situation where the level of equity that you run at in the good times is so high that, except in a 1 in a 200-year scenario, the worst that can happen is that the equity write-off is going to take you from 25% to 15%. And as long as you have a defined process at that point of saying, okay, guys, game over, you know, you equity guys, you've ended up, you haven't done your job, you're wiped out, you know, we'll take the asset for free and we'll tidy it up and we'll sell it off, in which case the state or the central bank will typically make a profit of that. I think that you can have a level of equity which is less than 100%, which makes the likelihood of hitting bank failure, with the consequences that that has for new credit supply and macroeconomic instability, so low that you've reduced it to the point where every 150 years, yes, you'll have to bail out the banking system, but as long as it's every 150 years, it's probably socially optimal to just accept that that's what we do. So that's my aim, and I think there can be a ratio which is high enough to achieve that, certainly if we're talking about straight loans. Now, your point is, how do we then deal with this proliferation of derivatives accounts and securities lending and repo, secured financing, etc., all the stuff that the investment bank trading operations did? Where you're quite right, Lehman's had an equity capital ratio of, say, 11%, though, of course, on a simple non-risk-weighted adjusted basis, that was much less than 11%. I don't know what it was, but against the absolute gross value of all the contracts they were in, it was probably just 1 or 2%. And that reflected the fact that the most egregious failure of our capital system before the crisis was the capital system that we applied to trading activities, where we said, it's up to you guys, the industry, to model your required capital on value at risk models. You are allowed to run those value at risk models by working out what's the worst loss at the 97% confidence interval that you think you could have over a 10-day period, and allowed them to develop their own models of, how bad could it be? And what they did was develop extraordinarily pro-cyclical models, which said in spring 2007, well, volatility in the markets is way, way low, so we don't need much capital, because given that volatility in the markets is low, the worst loss we can make in a 10-day period is X, so we don't need much capital, which ended up as a total pro-cyclical machine, because the very fact that you didn't then need much capital to trade made a whole load of people trade more, which has a short-term effect of driving down the volatility until you get a crack point, and then the volatility explodes. So I think the lesson of that is that our trading book capital regime was completely wrong. I think we have taken some steps, but not nearly enough to put it right. I think we should still be aiming for dramatic increases in required capital requirements against trading activity. I think the net result of that is probably, as the investment bankers will tell you, that less trading will occur. but I think some of this trading is completely unnecessary and socially useless in any case. It gets justified with iconic statements like market liquidity or the need for price discovery, which I think are rhetorical flourishes rather than things really well rooted in economic functions that we need. Clearly there is an important process of price discovery, but we don't need as much price discovery as we assert. So maybe I'm too optimistic, Larry, but overall I believe there is a level of equity capital ratio sufficiently high that it would cover losses in all states of the world, provided we roll on, as we are committed to roll on, to a fundamental review and reformation of the trading book capital regime, which is required. And on disclosure, I've always been in a camp which is, disclosures like motherhood and apple pie. I mean, nobody can be against it, but I'm not convinced that markets are efficient enough, or information processing processes are efficient enough, or people are sufficiently rational for disclosure and transparency to be as powerful a lever for stability, which, as I know you do.
One more question.
We want to hold an asset, which we call money, that can be available, used at any time, and it is final satisfaction of a payment. It's not a debt, but it's final satisfaction, a payment for a good or service. It's also inherent in economic life that sometimes households, certainly firms, want to be able to borrow for a certain period, and they want to be able to borrow for a period that is not a demand note. Now, in fact, of course, banks write a lot of demand notes. However, there is the understanding that provided the borrower is in good standing, that, and provided the bank is not in very deep trouble, that the money will not be demanded with no notice. So it seems to me that maturity transformation is an inherent and useful function of banks, and I see no possibility of any regulation that would effectively control maturity transformation, because it's easy for banks to write the terms of a contract, a note, saying it's a demand note, but in fact the practice is that they don't demand it.
Yeah, well, I think I agree with you. I mean, I'm not suggesting an abolition of maturity transformation, but I think you've highlighted something which I honestly just don't think that economics so far has provided a really good enough analysis of, which is what is the optimal level of both debt contracts and of maturity transforming credit and money creation. And I think this is very fundamental. There's a very lovely short essay written by the mid-20th century Italian economist Luigi Einaudi, and it's called simply Debts, or in Italian Debiti. And Einaudi, reflecting Simons, says, look, it's obvious that if we could create a world in which there were only equity contracts in both a capital finance and in a labour market fashion, we'd have a much more stable economy. So he said if all investments in business were equity investments, and if all labour market contracts took the form of shares in the profit, whatever the profit was, of the firm in question, then we would not have the fluctuations which arise from the inflexibilities of wage contracts and debt contracts, which led to, the Great Depression. And I think there's a reasonable case. But then he goes on to say, but we've got a whole load of debt contracts, and we've got them, and we've got fixed labour contracts, i.e. fixed wages. You're going to pay me, $30,000 a year, whether your company works or not, and you're going to pay me an interest rate of 5% whether you make a profit or not. These have arisen, he says, because of a fundamentally, naturally arising human desire for certainty. And human beings can't deal with the uncertainty inherent in every contract being an equity contract. And I think that's right, but I still think it leaves open the question, okay, so an element of debt contracts is a good thing, it's welfare maximizing, it responds to some needs of individuals in the way they invest, and the way that the company wants, certainty of what it's going to pay. But you can accept that argument and still believe that there could be too much. And I think maturity transformation is the same. I think the way that you have described it, which says that people in addition want to be able to simultaneously borrow money for 20 years and have some of their wealth invested in an instant access account, you can see why to lots of people and to businesses that's an attractive thing to do that gives all sorts of flexibilities, and you can see why the possibility of that may have been important to businesses making entrepreneurial commitments, which is part of the wealth creation process. So again, I think that maturity transformation it can be both an absolute welfare optimizing function, even if it doesn't drive growth, and I think it also may have contributed to growth. But again, that doesn't tell us that limitless amounts of maturity transformation are good. And I think one of the really missing bits of our understanding of economic theory is once you've accepted that some debt contracts is better than no debt contracts, and once you've accepted that some maturity transformation is better than no maturity transformation, I think we're way short of a good theoretical understanding or an empirical understanding of, but how much is optimal, given that I think there are very good reasons to believing that both of these things, once unleashed, have inverse U functions, that some debt contracts within society, debt to GDP is good up to a point and bad beyond that point, and some maturity transformation is good up to a point and then bad beyond that point. And I think we have neither good theory nor good empirical analysis so far, though I think it's beginning to help us locate that point. But I think it's one of the most fundamental, missing bits of our basic theoretical understanding of optimality in a monetary economy. And with that, I think I'm going to have to say it's been nice talking to you, and thanks very much.
Thank you very, very much.